What if the next big crypto crash doesn't come from an exchange blowing up, but rather from the companies Wall Street once celebrated as quote safe bets? In the early 2000s, the dot-com bubble wiped out nearly 80% of the Nasdaq, and history has a way of rhyming. Today, a new wave of companies that call themselves crypto treasuries are playing a very similar game, and the risks they're taking could have ripple effects across the entire market. My name is Danilo, and today we're diving into why these treasury companies are being compared to the dot-com bust, how their strategies actually work, and what it could mean for the future of crypto. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. To understand what's happening with crypto treasuries right now, we need to rewind to the early 2000s. Back then, investor psychology was on overdrive. All it took for a company to raise millions was a website and a catchy .com at the end of their name. Pets.com, Webvan, and dozens of others soared to billion-dollar valuations with little more than marketing promises and a vague vision of the future. For a while, investors didn't really care. The hype was enough to keep the money flowing, and stock prices climbed higher and higher. But when reality set in and revenue didn't exactly match the story, the bubble burst. The Nasdaq fell nearly 80% from its peak, and countless companies disappeared overnight. Only a handful, like Amazon and eBay, survived and went on to become household names. The lesson here isn't just about history repeating itself, it's about human behavior. Bold visions are easy to sell, but when the market does turn, it acts like a weighing machine. Companies that don't have fundamentals get quickly exposed, and investors holding the bag often learn the hard way. Now, fast forward to today. Instead of dot-com startups, we have crypto treasury companies. They've become the darlings of the cycle, attracting institutional capital and mainstream headlines. And just like in the 2000s, the mix of excitement, easy fundraising, and lofty promises has created a setup that feels eerily familiar. So, what exactly is a crypto treasury company? At its core, it's a business that raises money, either by selling stock or taking on debt, and then uses that money to buy Bitcoin, Ethereum, or sometimes Solana. In other words, instead of building products or services, their business model is holding crypto on the balance sheet. The key metric people watch is something called market net asset value, or MNAV. Think of it like a ratio. How much the company's stock is worth compared to the value of the crypto it actually holds. When the ratio is above 1, meaning the company is valued higher than its holdings, they can issue more shares at a premium, raise fresh capital, and buy even more crypto. That loop keeps the engine running. But when MNAV drops below 1, the game changes. Suddenly, it's no longer attractive to raise money by selling stock, and debt becomes much harder to secure. The whole strategy stalls out, because without that premium valuation, these companies lose their main way of accumulating more crypto. Once you understand the MNAV loop, it becomes clear why analysts are warning about a potential death spiral. Venture firm Breed described it as a chain reaction. Bitcoin's price drops, which lowers a company's MNAV. When that happens, raising money through new stock or cheap debt becomes almost impossible, and without new funding, these companies can't keep buying. Some are then forced to sell into a falling market, which drives prices down even further and pushes MNAV even lower. That feedback loop is where things get really dangerous. If enough companies hit the same wall at the exact same time, you get forced liquidations, fire sales of Bitcoin, and mounting pressure on the broader market. The stronger firms might scoop up the weaker ones, but for most, the slide ends in collapse. And this isn't just a hypothetical scenario. Corporate Bitcoin buying is already down more than 70% from its peak earlier in the cycle, and a growing number of treasury companies are trading below the value of the crypto they hold. Some are even buying back their own stock in a last-ditch effort to stay above the water. The risk here is quite simple. What looks like an unstoppable accumulation machine in good times can flip into a rapid unwinding once the cycle turns. And when the unwind starts, it doesn't just hurt the companies involved, it has the potential to drag the entire market down with it. No discussion about crypto treasuries is complete without talking about MicroStrategy. Back in 2020, Michael Saylor took what was then a business intelligence software company and transformed it into the largest corporate Bitcoin holder in the world. What started with a $250 million cash purchase quickly snowballed into billions of dollars worth of debt and equity raised just to buy more Bitcoin. For years, this strategy looked unstoppable. MicroStrategy stock surged more than 2,000% from its first Bitcoin purchase, outpacing even Bitcoin itself. Saylor framed it as a financial engineering at its finest, comparing it to Manhattan real estate development. When the land goes up in value, use debt to build taller and taller. Supporters saw it as genius. But there's always another side. Critics say the company has essentially turned itself into a leveraged Bitcoin ETF without all the safeguards. They warn the loop only works if Bitcoin keeps rising. If the price stalls, debt obligations don't go away, and dilution eats into shareholder value. Some analysts have even called it a Ponzi-like cycle, pointing out that new funding depends entirely on market enthusiasm for Bitcoin. And now in 2025, we're starting to see the cracks. MicroStrategy stock is down nearly 45% from its highs late last year. Insiders selling has raised eyebrows, with millions in shares offloaded just before major crypto pullbacks. Regulators are paying attention too, looking into unusual stock moves that happen before company announcements. This doesn't mean the strategy is doomed per se, it's worked remarkably well up until now. But it shows how fragile the model can become once the market turns. When the most famous example of the crypto treasury playbook is struggling, it forces us to ask what that means for the rest of the dozens of smaller imitations trying to run the same game. Up until now, the risks we've talked about come from market dynamics. Prices falling, MNAV collapsing, and debt turning into a trap. But in 2025, there's another layer of pressure. Regulators are starting to circle. The SEC and FINRA have already launched probes into unusual stock activity tied to treasury companies. Regulators want to know why some stocks spiked or sold off sharply right before companies announced major crypto purchases. Over 200 firms that added crypto to their balance sheets this year are now being scrutinized. That kind of spotlight changes the game. It's not just about whether these companies can raise money or survive the market downturns. It's about whether they've crossed the line into securities violations or insider trading. For investors, that adds an unpredictable wild card. Even if Bitcoin's price stays strong, a regulatory crackdown could crush valuations overnight. We've seen this before in crypto. Enforcement doesn't really always come gradually. It can land all at once, leaving shareholders with no time to react. For treasury companies already on shaky ground, the added pressure from Washington could be enough to tip them over the edge. History shows that bubbles don't exactly wipe out everyone. In the dot-com bust, most companies vanished, but a few survivors like Amazon and Google went on to dominate entire industries. The same dynamic is likely playing out with crypto treasuries. Standard Chartered has already predicted that only the largest and most disciplined players will make it through. We're seeing signs of that now. Strive Asset Management recently acquired Semler Scientific, combining their holdings into a pool of nearly 11,000 Bitcoin. Moves like this suggest consolidation is already underway, as stronger firms scoop up weaker ones at a discount. Some treasuries are even resorting to buying back their own stock to try to maintain valuations, a clear signal of stress. Others are leaning on cheap debt or creative financing to stay alive. The weaker these strategies look, the more attractive they become as acquisition targets for bigger players with the deeper pockets. The key point is that not every single company is doomed. Just like Amazon dropped 95% during the dot-com crash before becoming a trillion-dollar giant, some of today's treasuries could emerge stronger on the other side. But spotting those survivors means paying attention to who has real staying power and who's just coasting on hype. So, why should you care about what these companies are doing with their balance sheets? Because their actions don't just affect their own shareholders, they can ripple through the entire crypto market. If treasuries start unwinding positions in a downturn, it adds more selling pressure on Bitcoin itself, which impacts every investor in the space. At the same time, there's real opportunity here. The collapse of weaker firms will likely create openings for stronger players to grab market share and accumulate crypto at discounts. Just like the dot-com bust cleared the way for Amazon and Google, this cycle could leave behind a few clear winners who define the next era of adoption. For retail investors, the lesson is quite simple. Don't get caught up in the hype around quote institutional adoption without asking what's really behind it. Look at whether these companies trade above or below the value of their crypto, how they're financing their purchases, and whether they have real revenue streams outside of simply holding Bitcoin. Those details often make the difference between a company that survives and a company that doesn't. In short, understanding how these treasuries operate gives you a lens to read the market differently. It helps you avoid getting blindsided if things start to unravel, and it puts you in a better position to spot who might actually come out on top. Crypto treasuries were once hailed as proof that digital assets had gone mainstream, but just like the dot-com bubble, hype and easy money can only carry companies so far. The cracks are already showing. MNAVs collapsing, insider sales raising questions, regulators circling, and weaker firms being absorbed by stronger ones. Most of these companies won't make it through the next cycle, but the few that do could end up defining how corporations interact with crypto for years to come. That's the tension investors face right now. The same structures that could fuel the next wave of adoption might also be the spark for the next major crash. So, as this whole thing kind of plays out, it's worth asking, are we looking at the Amazons of crypto or the next Pets.com? If you found this breakdown helpful, make sure to subscribe and ring the notification bell so you don't miss future crypto updates. Thanks for watching, and I'll see you in the next one.